The markup will reconvene. People will either take seats or leave. The gentleman from Texas is recognized for an amendment.
Thank you, Mr. Chairman. I have several amendments. This one will be styled actuarially sound.
All right, the clerk will designate the amendment.
Amendment to H.R. 787,
I ask consent that the amendment be considered as read. We will hold off until it is distributed. And the gentleman from Texas is now recognized.
Thank you, Mr. Chairman. This is a fairly straightforward amendment. As we all know, government insurance programs, all of which supposedly are to be actuarially sound, notoriously do not end up to be actuarially sound. Witness the National Flood Insurance Program. We know Social Security is now looking at red ink for as far as the eye can see. Having an actuarially sound government insurance program is clearly the exception as opposed to the rule. FHA and FDIC are two such programs that have remained actuarially sound, financed by their premiums. I want to ensure that they remain actuarially sound. We all know that with the challenges that we're facing in this economy, there will be unprecedented pressures put on the FHA fund. If there are shortfalls, one of three things has to happen. Either number one, the program folds. Number two, premiums are adjusted to make sure the fund is actuarially sound. Or number three, taxpayers yet again end up having to fund the cost. Mr. Chairman, I believe that we are rapidly reaching the point of taxpayer fatigue. The stimulus bill that is pending in the Senate, at least the House passed version, when you add in the debt service, is a $1.16 trillion bill, which is roughly $14,700 for every single family in the United States of America. This again is a program that is going to bail people out, many of whom are deserving. Some we can question are going to be a little less deserving. But the basic question is, if we're going to put more pressure on the fund, ultimately who is going to ensure that the fund remains sound? I believe that it should be for those who benefit for the program as opposed to the taxpayers. And if you want to have an FHA, you have to make sure that the integrity of the fund is protected. And I believe that this amendment, Mr. Chairman, achieves that purpose. And with that, I yield back the balance of my time.
I'll recognize myself to say that this is a legitimate amendment. It is another version, though, of what we offered in effect, because it would essentially stop the program. This is inherent in any government loan program is some element of subsidy. You can regulate how much of it, and what this would do would be essentially to stop the program. It's a perfectly reasonable amendment to be offered by someone who's opposed to the program. Is there further discussion?
Would the gentleman yield on that point?
I will yield.
Just for the sake of clarity, as the amendment is written, I would say it would certainly suspend the program until such time that the Secretary certifies that the aggregate amount of premiums collected exceed the aggregate amount of insurance payments. So just for the point of clarity, it would suspend the program until such time that it was again made actuarially sound. And I think that
Yes, I think we would suspend the program until there was no element of subsidy and until you would have the amount of insurance, the aggregate amount of programs exceeds the amount of insurance. That is, it would reduce any potential element of subsidy. So is there any further discussion? If not, the question is on the amendment. All those in favor will say aye.
Aye.
Opposed, no. No. The noes have it. The amendment is not agreed to. The gentleman.
Mr. Chairman, I request a recorded vote.
Gentleman requests a recorded vote. Those joining with him will please raise their hands. Sufficient number. The recorded vote is ordered. The gentleman from Texas is recognized for another amendment.
Thank you, Mr. Chairman. This amendment is styled millionaire net worth.
I'm sorry?
millionaire net worth.
The clerk will designate the amendment.
Amendment to H.R. 787 offered by Mr.
I ask unanimous consent the amendment be considered as read. The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Since we had a discussion out of the committee that you were favorably disposed to the amendment, I will try to be brief. FHA was designed...
Gentlemen, being brief isn't hard.
Thank you, Mr. Chairman. Ostensibly, FHA is designed to benefit low and moderate income people. This amendment would simply say that if you have $1 million net worth, that you would not be able to benefit under the Hope for Homeowners program. We have to remember that, for example, Mr. Nardelli, who recently appeared before us, one of the CEOs of the Big Three, I think has voluntarily taken $1 a year salary. I believe previously he has made millions and millions of dollars. But if we're going to have confidence of the taxpayers within these programs, I don't think it's fair that the teacher, the fireman, the small business person uses their tax money to subsidize somebody who has $1 million net worth. With that, Mr. Chairman, I yield back to balance my time.
I'll recognize myself to say I think this is perfectly reasonable. We will get into some further discussions, I will say in anticipation that there's a big difference between $1 million and 125% of median income. $1 million is safely on the side, I think, of exclusion. And there's not enough money in the world to do everything you'd want, so I think this is reasonable. Any further discussion? If not, the question is on the amendment offered by the gentleman text. All those in favor say aye. Opposed, no. The ayes have it. The amendment is agreed to. The gentleman text is recognized to offer another amendment.
Thank you, Mr. Chairman. This amendment is styled 3 rules.
The clerk will designate the amendment.
Amendment to H.R. 787 offered by Mr. Henserling of Texas. Page 2, line...
I ask unanimous consent that the amendment be considered as read, and the gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Again, in a previous portion of the debate, I posed the question, who are you trying to help? Why are you trying to help them? And at what cost to their fellow citizens? Again, the chairman and I agree I'm not a fan of the underlying program. I believe there are better programs at economic growth who have the effect of foreclosure mitigation, be that as it may. If the $25,000 figure of CBO is even remotely in the ballpark, I do not believe, again, that this particular program is going to solve the housing crisis that we have in the nation. It enlarges the universe from roughly 2.5 million homeowners who have had their mortgages renegotiated on a voluntary basis to add some other universe. I suppose it somewhat begs the question, why doesn't Uncle Sam write a check to everyone who's struggling with their mortgage? We can simply send out letters and say, how much can you afford to pay on your mortgage? We, the taxpayers of America, via Congress, will pay for the rest. So we have a program that's going to enlarge the universe, but at some cost. But I do not believe ultimately this is a program that's going to solve the housing crisis in America. So if that's true, I, for one, believe again that the poor, beleaguered taxpayer has to be respected in this process. We know there are a number of people who are quite deserving of help, those who have become unemployed due to no fault of their own, those who have suffered illness, disability. But again, we have a whole universe of people who used their homes for ATMs when their neighbors didn't. They refinanced so that they could take the vacation to Vegas, buy the bass boat, buy the latest SUV. There were people who took zero down loans so that they could essentially speculate, and they ended up living in their investment, and they knew what they were doing at the time. A lot of the no-doc loans, as we all know throughout the industry, were known as liar loans, and we know that mortgage fraud on both the lender and the borrower side ran rampant, up 1,400% in this decade alone. And we know from the testimony we've received from our committee that the greatest amount of fraud took place in these no-doc loans. And so, again, I wish we could issue taxpayer assistance on a case-by-case basis. Probably not possible. But we know that the greatest percentage of fraud took place in the no-doc loans. We know that, I believe through testimony, that we have seen speculative investment in real estate in this decade at least triple, and we know that most of that came in the zero-down area. I would simply say that a large portion of the people in these two universes are going to be less deserving than other people in the universe of those who could be helped. Finally, with respect to the maximum income, again, almost every press release I see from FHA talks about helping low and medium income individuals. And so we have a provision that says the mortgagor shall not have a family income that exceeds 125% of the median income for the area in which the residence is to be covered. Now, that will be different in every single area, at least by nationwide figures. That figure would come in at approximately $75,000 of income, again, to ensure that if taxpayers are going to be asked to help individuals, that we try to restrict it to the more deserving as opposed to the less deserving, and we try to restrict it to low and medium income as opposed to high income. Again, at a time where the taxpayer exposure is absolutely off the charts, some attention has to be paid to the family budget as we continue to increase the federal budget. With that, Mr. Chairman, I yield back the balance of my time.
I recognize myself in opposition to the amendment. In particular, I want to focus on that last point about median income. There are places in the country where median income is maybe $35,000 or $40,000. So you're talking about people who make $48,000 or $49,000 a year being cut off. Secondly, I do appreciate the gentleman's going with median income, because that's what I've been trying to do with regard to FHA loan limits. But this would then have a very great differentiation. Some people making $60,000 would be eligible, and some people making $60,000 wouldn't be eligible. I mean, the relevance of median income here seems to me to be not fair. Secondly, there are fraudulent no-doc loans, but they were not all fraudulent. And people who were told a no-doc loan, we do have other sections in there about people who lied about their income, and we put that back in there. But if someone was told they could have a no-doc loan and was accurate, I don't understand why they should be prohibited. So I hope the amendment is defeated. Is there further discussion? Gentleman, Colorado.
And I just have a couple questions of the sponsor. And on the maximum income, so let's say the bottom has fallen out of the market in Lakewood, Colorado, which it hasn't, but let's say that's what it is. Median income is $55,000, $60,000. Let's make it easy, $50,000. So you're saying bottom's fallen out of the market. Somebody makes $65,000, not something under $62,500. There will be no assistance here. Is that? Am I doing the math right?
Is the gentleman yielding?
Yes, I yield.
What I'm saying, I don't know if you're doing the math right. I would say that if incomes are dropping, then all incomes are dropping. So certainly the median may be different.
No, I'm saying that the value of housing has dropped, so that it's now you have problem with housing. Income is still, it was $50,000. So under your example, anybody who makes more than $62,500, any family that makes more than $62,500 is ineligible for this program. Is that right?
I believe you have the math right. If I could just make one other observation, though. Those who are having to pay the bill are also having their income decrease, and regardless of what's happening throughout the economy, since pain is shared throughout, all I'm saying is whatever number is low and moderate income, the program ought to be directed to them. Whether it's $500,000 or $50, the program ought to be directed at low and moderate income individuals.
Let me reclaim my time. One more question, then I'll yield to the chairman. On Section 13, lines 7 through 10, if a guy made $1 down payment, would that suffice for your amendment?
I'm sorry, if the gentleman would...
It says, I just want to understand language. In connection with the origination of the existing senior mortgage, the mortgagor shall have made a down payment in cash or its equivalent on account of the property purchased under such existing senior mortgage. I assume that's $1 would be sufficient on your amendment?
Yes.
Okay.
The gentleman yields me. I just want to say I'm prepared to rule, because the gentleman raised a question, that $12,500 is 25% of $50,000.
Thank you. I yield back.
Is there further discussion? If not, the question is on the amendment. All those in favor will say aye. Opposed, no. No. The noes have it. The amendment is not agreed to. The gentleman from Texas is now recognized for another amendment.
Thank you, Mr. Chairman. This amendment is styled appreciation.
The clerk will read designate the amendment.
Amendment to H.R. 787 offered by Mr. Henseling of Texas. Page 3.
I ask unanimous consent that the amendment be considered as read, and the gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm hoping that the committee will take an opportunity to reconsider language that was in the underlying bill that is now being dropped, and that is the potential for direct taxpayer upside. What this would do would ensure that, again, we have language within the underlying bill that reads as follows: for each eligible mortgage insured under this section, the secretary and the mortgagor of such mortgage shall, upon any sale or disposition of the property to which such mortgage relates, each be entitled to 50% of any appreciation in value of the appraised value of such property that has occurred since the date that such mortgage was insured under this section. This was in the original legislation that was passed. It is now dropped out. The amendment would reinstate this language. Again, we are in an unprecedented time in our nation's economy. We haven't seen this level of pain clearly since the early 1980s and possibly since the Great Depression. We are in unprecedented bailout mania, some of which may be wise, some of it may be unwise, but all of which has a financial consequence to the taxpayer. Again, the stimulus bill alone that this House passed last week is a $1.16 trillion figure, almost $15,000 per American family when you count in the interest. Now, whether you believe in the legislation, you don't believe in the legislation, at least one facet of it that I think has been beneficial is in the other bailout legislation we have seen. At least there's a potential for taxpayer upside, be it either interest on a loan, be it the dividend payment and the opportunity for appreciation on preferred stock. The taxpayer is an involuntary participant in the program, and he's being forced, he or she, to put their family's money at risk to help somebody out who may deserve it, who may not deserve it. It may be fair, it may be unfair. And so I fear that, again, as I understand it, as I have listened to the debate, the thought is that it needs to be made more attractive to potential homeowners in order to participate in the program, but as you make it more attractive to them, you're certainly making it less attractive to the taxpayer. When already, before we even hit this recession, the average family in America was looking at almost $500,000 of unfunded obligations of the federal government. I mean, when does the madness stop? It seems to me to be a fairly simple proposition that if you're going to risk taxpayer money, and we know it's risky, we know that 40% of these loans have a great probability of redefaulting anyway. Is it too much to ask to say, Mr. and Mrs. Taxpayer, if you're going to risk funds as you're trying to send your kids to college, as you're trying to pay your mortgage, as you're trying to pay your health care premiums, that in exchange for you risking your hard-earned money, that if anything is made here, we'll at least give you half. Is that really too much to ask? I would hope it wouldn't be. I would hope that the committee would reconsider the wisdom of having this shared appreciation within this legislation. With that, Mr. Chairman, I yield back.
And I recognize enough to say I'm going to ask people if they would agree with me to vote against this now, but with the commitment that we would revisit it when this bill comes to the floor. I was in favor of it. We received a lot of criticism of it. A couple of points. One is there are problems with state law. So it is a preemption, apparently, of a lot of state law. I'm not opposed to doing that, but I want to make sure we know how we're doing it. And people have said, wait a minute, I'm in a bind between the two. There were some questions about how you define the profit. There were also some arguments that we asked for too much, and that we should get some appreciation to change the phasing. The gentleman from California mentioned this. I know the gentleman from Illinois had been interested in this. So I would hope that it would be defeated now, but I will guarantee that I would make it, yes, we will have an amendment in order on this when we come to the floor. There may be competing versions of it. I do think some shared appreciation is necessary, but I think we overshot in the one we did now.
Would the chairman
yield.
yield on that point? If what I'm hearing is if the chairman is willing to work with me on the subject matter and at least grant me the opportunity
Yes,
to offer an amendment.
Let me
on
take
the-
back my time. I will work with the gentleman. If we don't satisfy him, I'll support his being able to offer his amendment. We might have a different version of it.
In that case, Mr. Chairman, I would ask for unanimous consent to withdraw the amendment at this time.
Are there further amendments? If not, the question is on the bill as, no, I take it back. I move the previous question because we have some pending amendments. All those in favor of moving the previous question will say aye. Opposed, no. The ayes have it. The effect of this, by the way, for members who are new, under our rule, we roll the votes on roll calls so that members aren't caught not being able to vote on them. But we cannot complete action on the bill, obviously, until we have disposed of amendments. You can't approve a bill while there are still amendments pending. The Senate probably could, but we certainly can't. And so what we have now done is to say no more amendments will be in order, but there won't be a vote on the bill until we have voted on the amendments. And there are two amendments pending? Or two, I think.
I have an amendment.
Oh, the gentlewoman from Illinois has an amendment?
I'm at the desk.
Well, then I ask unanimous consent that the previous question be rescinded. Without objection, it is, and the gentlewoman is recognized.
Amendment to H.R. 787, offered by Ms. Bean. Page 1, line 9, after the semicolon, insert "and." Page 2, strike lines 3 through 6.
I ask unanimous consent the amendment be considered as read.
My amendment restores the original 5-year prohibition on assisted borrowers from being able to obtain a second mortgage. I know there's concerns about compliance with lenders, and FHA want to make sure that those who may already have second mortgages can be included, but we should not allow people to take on net new debt above and beyond the new loan that they're asking for as they get to be part of this program.
Will the gentlewoman yield?
Yes.
As the gentlewoman knows, I think that's generally a good point. We did want to make it clear, though, because the existence of second liens has been an obstacle to cleaning these things up, that there would be no obstacle, and that's why I would ask her if she would withdraw it, and we'll do this again when we come to the floor, to make it clear that an existing second lien holder would not be debarred here from making a deal to say no, allowing this to go forward with, and that individual would have the right to reinstate it.
And what I would hope we'd find is some language, and I'd be happy to withdraw this amendment if we can work out something that says they cannot add net new debt
I
over and
would
above the
certainly agree
value of
with
that
the gentlewoman
existing
on that.
second.
The gentlewoman withdraws the amendment, so I now again move the previous question. Those in favor say aye. Opposed, no. The previous question is ordered. The bill is now held. We're going to vote at 6:15. There are people going to and from the White House, and that's the best we can do. So now I call up H.R. 788.
H.R. 788, to provide a safe harbor.
I ask unanimous consent the further reading be dispensed with. And this is the Castle bill, somewhat modified on safe harbor. The gentleman from California, Mr. Miller, had an amendment he was going to offer. It was not germane, but it's relevant to a subject. I just want to make clear that he and I discussed this. It's about mark-to-market accounting. It's the subject we will be addressing in our, what we've called the mixed message hearing that's going to be coming up. And he acquiesces to that. So I now recognize the gentleman, Mr. Miller from North Carolina, for an amendment.
Thank you, Mr. Chairman. I have an amendment at the desk.
Clerk will designate the amendment.
Amendment to H.R. 788.
I ask unanimous consent the amendment be considered as read. Gentleman's recognized 5 minutes.
Thank you, Mr. Chairman. This is a clarifying amendment, and like most clarifying amendments, it's probably redundant. The paragraph that this amendment changes slightly obviously is intended to bar claims by anyone whose claim is based on a derivative contract. Derivatives themselves, collateralized debt swaps or credit default swaps, collateralized debt obligations, synthetic, whatever. But there is some concern among consumer groups that the language of this paragraph, since so many servicers were also originators, could be construed to reach claims against servicers who were originators based upon the mortgage itself by the borrowers. And this makes clear that that is not the case.
I recognize myself to thank the gentleman. That's very important. It's clear we are trying to prevent the original investor from suing if the servicer has made a good faith judgment that this is what's involved. I would remind people that the Accounting Standards Board, the FASB, has ruled that, and I think it's Accounting Standard 143, that if a servicer in good faith determines that the investors would be better off economically with a revised mortgage, namely that something would be better than nothing, that they've met their fiduciary obligation. This reinforces that. It doesn't change the law, but the basic bill does. What the gentleman was kind of doing, he explained it to me, and is that, as he said, it doesn't prevent a defrauded borrower from being in a lawsuit. Is there further discussion on the amendment? If not, the question is on the amendment. Those in favor will say aye. Opposed, no. The ayes have it. The amendment is agreed to. Question is now on the bill as amended. All those in favor will say aye. The gentleman, New York, have a comment?
Yeah, Mr. Chairman, I'd like to move to strike the last word.
Yes, the gentleman is recognized.
Okay, I am pleased. I just wanted to talk a little bit about this servicer safe harbor provision. The Judiciary Committee, on which I also sit, has reported a bill to allow bankruptcy judges the power to modify loan terms which provide an option for struggling homeowners to remain in their homes. And I do support this bill, but I do also think that it's critical that we encourage homeowners to seek modification prior to bankruptcy. And I believe that your bill, this bill, Mr. Chairman, in combination with the bankruptcy, will provide that critical safety net to homeowners struggling to keep a roof over their head. So I did want to compliment you. I think this is a necessary thing to make sure that is a companion to the Judiciary bill. And I'm pleased to support it. And I also ask unanimous consent that my full statement be placed into the
If the
record.
gentleman would yield, I thank him for that. We want to be very clear. It does, many of us support bankruptcy, but as a last resort. No one should be encouraged to go bankrupt. It's not something to use lightly. And what we are hoping is that there will be a variety of other measures that will make it less likely. So I thank the gentleman.
Yes, Mr. Chairman, thank you. And I do think that this will help ensure that there's the flexibility needed with the bank so that they can renegotiate prior to bankruptcy.
And if the gentleman would yield further, some people raise the question, are we here abrogating existing contracts in lawsuits? I was very impressed yesterday with the witness, Mr. Thompson, I think, Professor Thompson from Columbia Law School, who was the minority's witness, who has a very good analysis I would recommend to people about our ability to do this sort of thing and its constitutionality. And I was very impressed with that, and I would recommend that members might want to read that. It's in the last part of Mr. Thompson's testimony from yesterday. The question now is on the bill as amended. Those in favor will say aye.
Aye.
Opposed, no. The ayes have it. The bill's agreed to. And now I call up 786.
H.R. 786, to
I
make
ask your
permanent.
consent that further reading be dispensed with. Without objection, so ordered, and I recognize the gentleman from Pennsylvania to offer an amendment.
I have an amendment to suggest, Mr. Chairman.
Clerk will designate the amendment. I ask the consent the amendment be considered as read. Gentleman from Pennsylvania is recognized 5 minutes.
Mr. Chairman, my amendment provides an extension of the restoration plan period for the National Credit Union Share Insurance Fund to 5 years. This period is consistent with what the National Credit Union Administration has recommended. The assessment that credit unions will face as a result of their actions to shore up the corporate credit unions is going to place considerable strain on credit unions. This statutory change would give NCUA the ability to alleviate some of the strain. The NCUSIF is completely funded by credit unions, which maintain a deposit equal to 1% of their insured shares with the NCUSIF and are assessed a premium as necessary to ensure the NCUSIF is maintained at a normal operating level. The fund's normal operating level can be between 1.2% and 1.5% by law. The NCUA is authorized to set the fund's operating level within that range. The current operating level is 1.3%. While credit unions are generally healthy, corporate credit unions, which provide settlement, payment, and other services to natural person credit unions, have been particularly hard hit by the ongoing economic crisis. NCUA has announced a program to guarantee all corporate credit unions deposits and provide capital to the largest corporate credit union, U.S. Central. This action will likely require credit unions to replenish 1% deposit and pay a premium. There may be other insurance costs that credit unions will have to bear as the economic crisis unfolds. Just as the Deposit Insurance Corporation has considerable time to replenish its insurance fund, the Restoration Plan extension would allow NCUA to assess the premium charges over time. Without the change, NCUA will be required to make an assessment or assessments that bring the NCUS IF back to the normal operating level in a much shorter period of time frame, placing additional strains on the credit union system. If replenishment occurs all in the same year, it reduces capital and results in a reduction in lending because capital must keep pace with lending. This is simply bad for the economy. I therefore offer this amendment, which I urge my colleagues to support.
Is there further debate? I would just note that, to be clear, what we do in the underlying bill at the request of the FDIC is to allow a stretch out so that the increased assessment appropriate to higher levels of liability doesn't hit them too hard. This extends the same to credit unions. Is there further discussion on the amendment? If not, the question is on the amendment. All those in favor will say aye. Opposed, no. The ayes have it. The amendment is adopted. I recognize myself to offer an amendment. Well, no, let me recognize first the gentleman from Illinois to offer a related
Thank you,
amendment.
Mr. Chairman. I have an amendment at the desk.
Clerk will designate the amendment.
Amendment to H.R.
I ask unanimous consent further reading be dispensed with. The gentleman from Illinois is recognized.
Thank you, Mr. Chairman. My straightforward amendment would increase NCUA's borrowing authority from the Treasury Department from the current level of $100 million to $6 billion. The NCUA has requested that its borrowing authority through the National Credit Union Share Insurance Fund be increased to a level that keeps pace with the growth of the industry since 1971, when the current level of $100 million was established. Over the last 38 years, since the borrowing limit was set, credit unions have experienced tremendous growth, and as a result, their equity in the Credit Union Share Insurance Fund has increased from $6 million to $1.6 billion. That's what they're paying in. According to the industry, an appropriate borrowing level for NCUAs based on equity balance would be closer to $30 billion. The $6 billion in my amendment represents a compromise between the 1970s era level and the industry's request, and the stakeholders agree that this amount should give the NCUA the additional resources it needs to manage the Share Insurance Fund and to adequately address and liquidity problems that may arise. This amendment is also consistent with the changes that are making in the FDIC's borrowing authority in the underlying bill and through the chairman's amendment. I request that the letters in support of my amendment from the Credit Union National Association and National Association of Federal Credit Unions be entered into the record, Mr. Chairman.
Is there further discussion on the amendment? If not, the question is on the amendment offered by the gentleman from Illinois, the chair of the Financial Institutions Subcommittee. All those in favor will say aye.
Aye.
Opposed, no. The ayes have it. I recognize myself for an amendment.
Amendment to H.R.
I
788.
ask unanimous consent the amendment be considered as read, and I recognize myself. A number of members had raised this. The FDIC sent us a request that their borrowing authority be raised from $30 billion to, and this was what they said, $100 billion or whatever else we want. They didn't use exactly those phrases, but that's what it meant. Whatever else we want made a lot of people nervous. That is, an unlimited amount seemed to us unwise. So this would put the $100 billion in there. It is what they asked for, and I would ask unanimous consent at this point to insert into the record a letter dated February 2nd from the chairman of the Federal Reserve saying that the FDIC should be allowed, he agrees that they should be allowed to borrow, that it should be increased to $100 billion. So this would put a cap on it, not make it unlimited. I think it's been clearly demonstrated if there was a terrible emergency, we would respond. I think putting something unlimited out there is just unwise public policy. Any further discussion on the amendment? If not, the question is on. Did I hear something? Oh, God bless you. And without further discussion, the question is on the amendment. All those in favor will say aye. Opposed, no. The ayes have it. The amendment is agreed to. The question is now on the bill as amended. Those in favor will say aye. Opposed, no. The ayes have it, the bill is agreed to. We have one pending bill, we have.
Mr. Chairman,
Yes, I recognize the gentleman from Texas.
I'm going to ask for some indulgence here. I was with one of my other colleagues, your colleagues, Mr. Scott, with an organizational meeting in our livestock subcommittee.
We got an amendment to the first
And I'd
bill.
like to ask you to vacate the vote on H.R. 788 and allow me to offer an amendment.
Well, I'll vacate, I would ask unanimous consent to vacate the vote on the previous question. We didn't vote on the bill yet because we have pending roll calls. So
Oh,
we'll just
okay, I thought you,
Oh, 788, I'm
Yes,
sorry.
yes.
Oh, 788, the safe harbor bill. Oh, all right, I would ask unanimous consent that we vacate the vote, and the gentleman is now recognized. I call up the bill again, 788, clerk will designate it.
H.R. 788 to provide a safe
I
harbor.
ask unanimous consent the reading be dispensed with. It's actually interesting, some reporter with nothing better to do told me he was writing a story about ghost stories on Capitol Hill. I said I didn't have one, but now that we have brought this back to life, I suppose I do. Maybe he'll find me again. Gentleman from Texas is recognized to offer an amendment.
and I appreciate the chairman. I have an amendment at the desk.
Amendment to H.R. 788 offered by Mr. Nagarbar of Texas and Mr. Price of Georgia. Page 5, after line 6, add the following new subsection. Legal costs. If an unsuccessful action is brought against a servicer by any person.
I ask unanimous consent the amendment be considered as read, and I recognize the gentleman from Texas.
Thank you, Mr. Chairman. I think we've been talking today about encouraging servicers and people to help with families that are having difficulties paying their mortgages and helping them being able to do that. And one of the things that I think we ought to do is make sure that we have a playing field that encourages people to work together. This amendment I worked on with Mr. Price curbs frivolous lawsuits by putting investors on the hook for legal fees if they unsuccessfully sue the servicers. And so this restores language that was in the chairman's original bill, H.R. 384, which the House passed last month. With this change, if an unsuccessful action is brought against a servicer, the person who filed the suit must cover any legal costs incurred by the servicer. In an environment where we ought to be pursuing every possible solution to encourage mitigation efforts, I was surprised to see that this language was not included in this version, but was in the earlier version, and I supported Mr. Frank's original language, encouraged my colleagues to do the same.
I thank them, and let me recognize myself to say this is a matter of comity with a fellow committee. This is a very important philosophical principle in American law, whether or not you should have the loser pays. I mean, as you know, the English system more commonly has this than the American system. I'm going to vote against the amendment now because, well, I'd be ready to consider this. I don't want to see us start doing it piecemeal. And the reason for the change was very strenuous objections from our colleagues on the Judiciary Committee, who believe that the whole question about whether or not you move to a loser pays regime, ought to be considered not cause of action by cause of action, but generally. So that was the reason for it. Gentleman from Alabama.
I'm recognized in support of the amendment.
Yeah, go ahead.
Mr. Chairman, I think the strenuous objections from the Judiciary Committee were from the Democratic members. I know Republican members believe, at least in this case, and I think most of the members on our side, that because we are concerned about foreclosures and we are concerned about its effect on the families, that we believe the lenders ought to step up to the plate and they ought to take responsibility, not so much the taxpayers. And there are certain investors who really don't care if everyone else takes a bath, as long as they get their 3%. And the lender be damned, the borrower be damned, the neighborhood be damned, the community be damned. It's all about greed. And what this bill does, and I commend you, it cuts through that Gordian knot, but it doesn't go all the way. And because this provision isn't in it, there will be many times when somebody with maybe a 2% interest in this mortgage, or someone that's guaranteed the first 3%, They say to heck with everybody else. And you have drawn very strict requirements. And only in a case where they go to court and they contest this, they hold it up, they drive up the cost to the taxpayers, because this is a taxpayer-funded program. Make no mistake about that. Drive up the cost for the borrowers, delay a workout, create an uncertainty and anxiety, contest it with the lenders, drive up the cost to the lenders. I, for one, would regret that in a situation like that, that party escape without paying the cost. And you originally included this provision in the bill, and I commend you on that. I'm sorry that you've taken it out. I think that the equity and the fairness is all on the side of having this amendment. And I have very little sympathy for a person that's willing to let everybody else go down the drain to protect their little interest, when they would still, during a workout, would still receive probably 70 or 80%. It's that greed that we've all seen that got us into this situation. Now, I don't know what the gentleman from North Carolina, but you know what I'm talking about. And, I don't think the merits are with these folks. But, if you want to let them go, let them walk, not make them pay. You have an opportunity to vote against this amendment.
Mr. Chair.
Thank you very much, Mr. Chairman. I'm concerned about the patchwork effort to deal with the service industry without us having a handle on how this industry truly works. I've asked my staff to put together a roundtable to just talk with servicers, both independents and those who are with some of our major servicing firms connected to the financial institutions, so that we can understand a lot more about the contracting relationships that they have. I understand that these contracting relationships vary all over the place, that there are some where the servicer must pay the amount of the mortgage that's in default for a period of time. I understand that that is not the case in other contracts. I do know this. If this amendment relates to the investor and not to the person who's paying the mortgage, the citizen who is trying to get a loan modification, that may be one thing. But I want you to know that what we're discovering in these modifications and working with services, we're learning that the original contract, the mortgage contract, was fraudulent, that under predatory lending practices in many of our institutions, we find that there are signatures made by brokers or others that the person was not aware of. We find that in one case, we have an 89-year-old man who was in the hospital who...
Will the gentlewoman yield?
Yes,
Yeah, just under the amendment by the gentleman from North Carolina, this clearly applies only to the investors. The gentleman from North Carolina's amendment to the underlying bill made it clear that this would in no way apply any of this to a borrower.
All right. Well, that makes it a lot better, because I would not want a person seeking some kind of justice through modification to be burdened with the responsibility of having to pay an unsuccessful action because they didn't have a good attorney, et cetera, et cetera. So that helps.
The gentleman's amendment makes this whole thing inapplicable to the borrower.
All right. Now, but still continuing, I do think that we would be wise to really hold our hearings and to learn more about this industry so that we could do a comprehensive piece of legislation. And I'm not opposed to paying servicers. I'm not opposed to incentives at all. But I do know this, that we have an unregulated industry here that we don't know enough about, that we ought to learn more about so that we can do a comprehensive job of making sure they're able to be in business, to do loan modifications, they're treated fairly, but at the same time, that they would have to respond to those who are trying to be in touch with them, that they would have to have adequate personnel in order to deal with the complaints, et cetera, et cetera. So that's why I'm opposed basically to all of the patchwork amendments and bills related to this industry at this time.
Would the gentlewoman yield?
Yes, I would yield.
Well, thank you. You know, I think actually you and I are in this particular area are have the same concern. And what we're saying here is we don't want servicers to be reluctant to go down that modification road with the fear that investors are going to start filing frivolous lawsuits on them, saying, you know what, here's my recovery strategy. I'm not going to worry about what the servicer can get for me. I'm going to see if I can file a lawsuit and make it so.
Reclaiming my time.
Yeah, go ahead.
If you take a look at the little bit that we're learning, there are servicers who make a lot of fees from doing loan modifications, and they include legal fees from doing loan modifications. And then you have these private, separate servicers who are not connected, independent servicers who are not connected, who are charging upfront fees before they enter into any attempt to do. So all I'm saying is, yes, I don't mind trying to protect the servicer, but on the other hand, I want to make sure that we know everything about the services so that we can too protect our citizens from some of those practices that you would not agree with either. It's just that we're doing a patchwork quilt here and not a comprehensive approach.
Gentleman from Colorado.
Just a couple quick points, and to the gentleman from Texas, I don't really have an objection to the amendment that you have, but two things. One, I think Ms. Waters is on the right track. The service industry, we need to have a much better understanding of how they do business, and it's not to say all of them are angels or none of them are angels or whatever, but what you have here, two things. One, the contract between the servicer and the investor may already have an attorney's fees clause, for one thing, and it may go both ways. The other is you've got a one-way loser pays provision here, which I'm not sure is appropriate, that the servicer may screw it up and the investor wins the lawsuit and the servicer doesn't have to pay attorney's fees, but it's not a two-way street, and for that reason I object and I can't support your amendment.
I recognize myself to say that I've just had a conversation with the gentleman from Texas. I'm informed by our parliamentarian, who I would remind the freshman was the parliamentarian. There's a lot of talk about bipartisanship, but we got a real bipartisan parliamentarian because he was the parliamentarian when the Republicans controlled the committee, and he was a point of continuity, and I think no one has ever questioned his independence. If this amendment were to be adopted today, it would trigger a referral sequential to the Judiciary Committee. While they might not always take that, this is a very important point to them. So on the other hand, I would note if this were to be adopted on the floor, then there's no such thing as sequential referral. So I would yield to the gentleman from Texas.
I appreciate the chairman, and I will withdraw the amendment and look forward to working with him on making sure we have an opportunity to discuss this important issue in the final passage. And
question recurs on the bill as amended. Yes, as amended. All those in favor say aye. Aye. Opposed, no. The ayes have it. The bill is agreed to. We have, I think, 3 roll calls, 2 amendments, and passage probably on the Hope for Homeowners bill. And yes, we have 3 amendments. We have the gentleman from Texas, Mr. Neugebauer's amendment. We have then 2 amendments. No, I take it back. We have the gentleman from Texas, Mr. Neugebauer's amendment, the gentleman from Texas, Mr. Hensling's amendment, and then a vote on passage.
Mr. Chairman?
Yes.
If we could have a 3-minute recess, we'll determine whether or not we may withdraw our request for.
Certainly, I appreciate that, gentlemen. We would have that. I apologize for timing. I would say again, and we're going to be able to do better, but last week and this week, we lost Thursdays and Fridays to our retreats, and so that compressed the schedule. But certainly the gentleman makes a reasonable request.
Yeah, and we'll come back 5 minutes, and hopefully we can dispose of the matter. Thank you.
The committee will reconvene, and I recognize the gentleman from Alabama, the ranking minority member.
Mr.
The
Chairman,
gentleman gets unanimous consent to speak.
unanimous consent that we call the all matters up for a vote at this time.
The gentleman has unanimous consent to rescind the 2 requests for a roll call that are pending. Is there objection?
Or we can voice vote them. I mean,
Well, but we got to. Well, that's true. We will. Can we rescind? We have to rescind. We will put the question again on the 2 amendments. The gentleman from Texas, Mr. Neugebauer's amendment.
Yeah, and thank the chairman. And as you and I just discussed,
Well, I agree. I would agree that the gentleman from Texas, in consideration of this, I would have been for his amendment being in order at the Rules Committee, but this will reinforce that.
Thank you, and I appreciate the chairman.
All right. The question then is on the gentleman from Texas' amendment, Mr. Neugebauer, about it was his amendment to kill the whole thing. All right. All those in favor of the amendment say aye.
Aye.
Opposed, no. No, the noes have it.
All right.
The gentleman from Texas, Mr. Hensling's amendment to be actuarially sound. All those in favor say aye.
Aye.
Opposed, no. No, the noes have it. Both amendments are defeated. The question now is on the HR 787 as amended. Am I get that right? So yes. The hope homeless. All those in favor will say aye. Opposed, no. The ayes have it. The bill is agreed to, and we will proceed, and I will reaffirm that I believe this is one where several amendments, I will work with the minority to make sure they're made in order.
Thank you.
I thank everyone for their cooperation, and the meeting is adjourned.